Thanks, my man, Richard. And it's great to be back. And hope you're having a great day, everybody. Yeah, the let's see. Last time we talked about the time value of money and present value calculations, and then net present value, discounting cash flows, net present value, internal rate of return. Those are all sort of future-looking tools where you're looking into the future and then pulling value back to a present value number. Now, with ratio analysis, what we're doing is looking at retrospective tools, looking backwards to see how we've performed. They're just performance-based measurements. And as they say, what gets measured gets managed. So we really have to have some tools to measure how we've performed and how we performed against other companies, or how, companies we're interested in investing in, how they rank next to other companies and things. And that's the basis of ratio analysis. It's an investment tool, and it's also a management tool. And so what really, I'll start with what is ratios and what is ratio analysis. What ratios are basically fractions. They're one number over another number. And what they allow you to do is to normalize businesses, because every business comes in different shapes and sizes, right? And how do you compare apples to apples? You have to have some sort of tool that's going to say, okay, this giant company like Amazon or Microsoft or something, I want to see what that company, or Google, a company like that size, how does that rate next to this little small capitalized company that I'm interested in investing in? Maybe is one performing better than the other? And how do you compare a tiny company, say a company with $100 million capitalization to a company with a $3 trillion capitalization like NVIDIA or something? Well, the way you do that is with ratios. What ratios do is they normalize the numbers. So you can think of any kind, and where you find the numbers to do the ratios are on the financial statements. So, and financial statements, as we talked about, are the end product of accounting. So you do all the accounting numbers, you have all the revenues coming in, all the expenses, you have all your different categories, and those numbers get summarized in financial statements. And the financial statements are a balance sheet, an income statement, and a cash flow statement. Those are the three financial statements. And it's really important for all of us to understand how to read and analyze financial statements. And so that's where we get the numbers to do our ratio analysis. You might get an income statement ratio might be revenues to net income. And you can see that, the revenues are, that's your sales, right? That's the top line. And so say sales are $100 million. And then your net income, after expenses, what's left over, profit, net income is also called profit, and also called earnings. So you hear those words like earnings, net income, profit, and you wonder, what the heck are all those different words? They're the same thing. They're synonyms for each other. So we can call it net income in this case, and or earnings or profit. And that profit is the bottom line. You always hear that phrase, like the bottom line is this or that. That's the number that you really want to look at. After you have your sales, your revenue, all your expenses that you take out, what's left over. And that's the important number. So say the sales are 100 million and net income is 10 million. Well, if you put that together as a net income over sales ratio, that would be 10%, right? 10 to 100, is 0.1, 10%. So then you can say, okay, here's another company and they have $100 million in sales, or they have $200 million in sales, and they only have $5 million in net income. Well, that would be a much lower, that would be 2.5%. So in that case, the bigger company with bigger sales, but their earnings ratio is less, that the sales ratio is less. So that's how you can compare. So that's just an example on the income side. Say on the there's several types of ratios. There are earnings ratios like that, and you'll see those when you're in the stock market. There'll be things like earnings per share, and that's how much the company net income is per how many shares they have outstanding. Say if a company has just for easy numbers, say a company has $2 million of earnings or profit or net income, that's the number, $2 million, and they have 1 million shares outstanding. That's how many shares of their stock are out, out in the market and things. So earnings per share would be 2 million divided by 1 million, or $2. That's the earnings per share. And the per means that's sort of the line in the ratio, right? So earnings per share, you'll see that a lot if you look on stock market, like on Google stocks or Yahoo, Yahoo stocks or something. You'll see EPS, earnings per share. What the heck does that mean? Well, that's what it means. It's like you're dividing the total amount of net income by how many shares are outstanding, so you can see how much of that income is going to each share that you buy. So that's a profitability type of metric. Those are an activity ratio, they'd call those, or profitability. How profitable is a company? Like we talked about sales to net income or something like that. The other kind of category of ratios is leverage ratios. And leverage ratios are how much, what we call leverage in a company is how much debt a company is carrying. So this is a balance sheet ratio, right? You're taking, a balance sheet has the assets on one side, and those assets are financed by debt and equity. And it's just like a house, right? Think of it as a house, a balance sheet. You have a house, and that value of that house is measured by an appraisal, right? And so say your house is worth $1 million, and you have you have a loan of $750,000. That's 3/4, and then the rest would be the equity in the house, $250,000. That's how much you actually own, right? That's how much the shareholders own. And when a house, that's how much your equity is. And as the house goes up in price, the debt stays the same. So that means that then to balance these out in the balance sheet, that equity is going to go up. So that's, people get happy when, prices in the neighborhood go up, because then their equity is going up because the debt stays the same. That's called leverage. When you have the debt doesn't move, it stays the same. So if you can increase the value of the assets, then you're increasing the value of the equity for the shareholders. And so a debt to equity ratio would be a leverage ratio. That would be a ratio on the right-hand side of the balance sheet, how you're financing those assets. So a debt to equity ratio, most companies, you don't want to have more than, say, half of it be debt and half of it be equity. Sometimes companies are more levered than that. It might be 75% debt, 25% equity, like we talked about here. So that's a debt to equity ratio, and that's a leverage ratio. And then there's activity ratios, and they're performance measures in a company and in your life too, you think of, but all kinds of performance ratios. You can do all kinds of things. Working capital, how much, current assets to current liabilities, how much do you have to fund? That's the quick ratio and the acid ratio. These are all performance ratios for liquidity. Do you have enough money to pay your current bills? Basically is what liquidity is. Solvency is long-term. Do you have enough money to stay in business? And you do the same kind of things. How much, equity do you have to your current, bills? And some ratios go across. You might have one number from the balance sheet, one number from the income statement. Activity ratios too would be things like, say, inventory turnover. How fast is a company turning over the inventory they have? Say if you're making a bunch of TVs and suddenly the inventory is getting higher and higher because you're not selling as many and you're building more. That's a red flag for a company, right? They're building up their inventory. So you do inventory turnover. A lot of times you'll do accounts receivable turnover. How often do the accounts receivable come in? Accounts receivable are, you sell something and instead of getting the money right that day, you say, the customer has 30 days to pay or 60 days to pay. And so that's a cash flow problem, right? Because you've sold your stuff, but you didn't get the money for 60 days. How are you going to fund that? So you want to keep those accounts receivables ratios short and tight. And if, sometimes a bunch of your customers just say, I'm not going to pay. And that could run, a company into a cash crunch. So you have to monitor accounts receivable. So there's all these sort of activities in a company that you would measure. Say in a restaurant, you would measure how quickly do you turn over tables, right? If you have 10 tables in the restaurant and everybody stays at the tables for 5 hours, you're not making much money. But if you can get them, turning those tables every half hour, then you're going to be able to serve lots more people in that amount of time. So that would be an activity, an example of an activity ratio that a company would have. So those are basically some examples of ratios. I go way into all this kind of detail, how to understand financial statements all in my courses, but that's basically the idea. It's ways to compare companies to companies, and and those are called vertical ratios, where you're taking one, balance sheet or income statement and comparing to another. And then there's also longitudinal ones, where you're looking at a company over time and saying, what are their growth prospects? Are there, did their sales went from 1 million to 2 million, 3 million to 4 million, or their sales went from 1 million to 900,000 to 800,000? Are they growing? How fast are they growing? And so that's longitudinal. That's taking two numbers over time and comparing them to each other. And you do this in, percentage.
Talk to us about the risk and return.
Risk and return. Well, that's all related to these kind of ideas. Yeah, in investing in any type of income producing asset, you want to know what is the risk of you actually getting that return, that income stream that you're buying, that you're investing in, that you're projecting. So you really want to, there's a number of ratios to do that. The Sharpe ratio and PEG, price equity growth, where you're looking at how risky is what are the chances of you actually getting that money in the future? Is a company, what's a bankruptcy risk? What's the competitive risks of other companies coming in and beating you to the punch? And so you want to make sure that the return that you're getting, you're going to discount that based on some sort of discount rate, and that discount rate is going to incorporate the risks that you've estimated in there. Now that's not really a science, it's like you're making guesstimates and guesses about what those risks are going to be, and then interpreting them into a percentage, and that's going to be the discount rate. The higher the discount rate, the less valuable future cash flows are, right? The lower the discount rate, the more sure you are of those future returns, and so the higher that present value as you pull it back to present value. So everything is about risk and return in investing.
So you were talking before about in part one about the importance of knowing corporate finance. Let's say for an entrepreneur, what happens if the business that you're trying to buy or looking to cook the numbers?
Well, that's a very good question, Richard. It's keeping trust in the public markets, the investors trust that the companies are actually reporting true numbers, is super important. That's the job of basically the oversight government agency called the Securities and Exchange Commission. And what they do is they try to ensure that companies are doing doing the right numbers. And it's interesting how all that formed. I mean, because keeping confidence, investor confidence in the markets is absolutely critical. If people don't believe that these numbers are correct and that the companies are cheating, all that, or the market's rigged in some way, then people don't invest. And so that money doesn't flow to these promising companies, and they get to do what they want to do. And that's what makes prosperity and economic growth. That's the big theory behind it. Up to the 1920s in the United States, there were stock markets, and they called it the Roaring Twenties, right? 1920s, about 100 years ago, and stocks were just booming and stuff, and people were just investing on tips, and there was no Securities and Exchange Commission, and there was no reporting by the companies. It was just like sort of hearsay. You hear a rumor, oh, this railroad company is going to do really great. And so people would pour their money into it. And sometimes they'd make money just because more money's going into it. It inflates the prices, right? Until October of 1929, when suddenly all of the confidence came out, people pulled all their money out, and it fell like a house of cards. It was the great stock market collapse, Black Monday, they called it, of 1929. And when the stock market collapsed, a lot of the assets on the banks at that time were stocks. All those collapsed, and suddenly all their equity went away, right? And suddenly they were all underwater, like a house that's worth less than the mortgage kind of thing. And all the banks started to collapse. And then people panicked and they wanted to get their money out of the banks. So they rushed to the banks to pull their money out. And then the banks didn't have any more money. And sort of this cascading effect, there was a banking crisis. All the banks, folded. The stock market collapsed. So all that wealth that was created, was paper wealth, evaporated. And then we were plunged into the Great Depression. That happened in the 1930s. And at that time, we elected Roosevelt, Franklin Delano Roosevelt, as president. And he came in, and one of the first things he did was to create this Securities and Exchange Commission to go and oversee the stock market and make the requirement that all the companies had to report financial statements once a year, audited. That meant an outside accounting firm that wasn't with the company had to look at their books and say, yes, these books have been done by all what they call GAAP, generally accepted accounting principles. And so every company had to adhere to that if they wanted to be listed on the stock exchange. And to this day, that's the case. And so that made, suddenly there was these reports available, financial statements that were publicly disclosed. People could look at them, and they were sanctioned by outside accounting firms that would say, yes, these financial statements have been produced in accordance with GAAP, the accounting principles. And so that made for a more rational environment where you could go and look, and then you could be more comfortable that these companies aren't cooking the books. These are good numbers that have been, looked at by accountants and all that. And to run the Securities and Exchange, very interesting. Franklin Roosevelt picked somebody who was known as a big stock, manipulator in the 1920s, because he thought it's like that thing, it takes a thief, he thought that this guy, because he was so good at manipulating the stocks and doing all these kind of fraudulent things, he would be a great person to run the SEC, because he would know what all the tricks that were, and then he could go and make rules that would plug up all those holes where the tricksters could operate. And that guy was Joseph Kennedy. He was the president, John F. Kennedy's father. And so he was the first head of the SEC, and that's how that started. And then right after that, because suddenly now there was these financial statements that are available for people to read and interpret, a guy named Benjamin Graham, who was a professor at the business school at Columbia University in New York, Benjamin Graham, and he was Warren Buffett's mentor. Warren Buffett went there, and Benjamin Graham was his, mentor, and Buffett was his protege. He wrote a book called The Intelligent Investor, and it was based on how do we now interpret and analyze and invest based on these newfangled financial statements that we're seeing. And so that started that book is still a Bible among investors, as far as, this is where you're going to learn the fundamentals of financial analysis based on looking at financial statements, digging into them, doing all this kind of ratio analysis and looking at these numbers and seeing if companies are good companies. That's basically what Warren Buffett says he does every day. He reads 500 pages of the documents, the reporting documents that a company has to do each year is called a 10K. That's the official SEC name, 10K. It's an annual report. It has all of where they talk about the risks to their business, what's going on with the business, any lawsuits they're involved with, and they also have their audited financial statements in there, their balance sheet, income statement, and cash flow statement. So that you can get those, they're publicly available. You can go on the sec.gov, website and look at the 10Ks and look at any company and start to analyze Apple or Google or any publicly traded company, has to disclose these things. So yeah, that's the way we've combated cooking the books. But to your question, there's still lots of companies that every once in a while there's, scandals where, like Enron and WorldCom in the early, 2000s, where they were cooking their books. They had all these off-balance sheet financing tools and stuff. And then when those companies were caught, in fact, in the case of Enron, they got caught, and Arthur Anderson, which was the premier accounting firm at that time, they were their outside auditors for Enron. That company had to go bankrupt because they were, by the government, said that they were complicit in these fraudulent books, these cooked books, and fraudulent reporting that Enron was doing. And Enron went away too as a company. And then they came in, they did a rule changes called Sarbanes-Oxley. Sarbanes and Oxley are a senator and a congressman that got together and did a bill to tighten up the rules and regulations of how a company needed to report on those 10Ks. So it's an ongoing thing. Companies figure out ways because they want to make their company look, it's a beauty contest, right? As good as possible on those financial statements. And sometimes they go over the line, and then they have to come up with new rules to say, no, you can't do that. Or, because people then get excited about the numbers that they're seeing, but they're really not that accurate. General Electric used to do that all the time. They wanted to have measured growth every time. So a lot of times if they weren't going to meet their growth numbers, Jack Welch or the head of GE, would go to all the different bosses of all the different unions and say, I need you to, book X amount of sales this week and this X amount of sales, even if they're not real, because we have to meet that 5% or whatever it was growth number that they wanted to have. And they wanted to have stable growth, predictable growth, so that their investors could feel comfortable that this company's just marching along. And a lot of times those numbers were not totally accurate.
Explain to us discounted cash flow.
Discounted cash flow. Yeah, well, we talked about those ideas last week too. It's basically based on the time value of money and that risk versus reward, and the risk being the discount rate that you're going to apply to future cash flows that you're getting. So when you're looking at an income producing asset, say a rental property, it could be a stock or anything, but say a rental property, and you have have a home that you're renting out, and that home you're charging the rent, and the rent is $1,000 a month, and so you're getting that rent. Well, what's the risk of you getting that rent into the future? You may have a tenant and then they leave, and then you're going to rent it to somebody else, but you can't find a tenant for 2 or 3 months, so you don't get any money during that time. That's a risk, right? That's a risk to that cash flow. So you have to bake those risks into your discount rate, and then you take each year and you apply that discount rate to each year's cash flow, and that pulls that back to a present value. So a cash flow in year one will be that $1,000 will be worth more than that $1,000 in year 5, because it's riskier out there and you don't know what's going to happen in the world. And it's also further out. It's better to have $1 today than wait 5 years for $1, right? Because you could put it in the bank and get interest on it, basically. So you have to say, well, that $1,000 out 5 years at the discount rate I've decided is really only worth $712 in today's dollars. And so you add up all of those annual cash flows and you bring them back to a present value, and that's discounting cash flows. You're discounting those future cash flows back to a present value, so you have a number in today's dollars that you can compare it to other options that you may have for using that capital, using that money.
Some people sometimes might hear the word EBITDA. Can you explain what it is?
EBITDA, well, that is we talked about income statement, and you have the revenues, expenses, and net income. That's an income statement. Now, net income, that's the bottom line after your expenses, right? EBITDA is a form of net income, form of profit. No, it's earnings before interest, taxes, and amortization. And so you're saying, you're going to take those earnings before you subtract any interest expense to your debt, right? How much you had to pay for debt, and also before your taxes, so before you pay taxes. And also amortization is a term for when you have assets, and say assets are, they're on your balance sheet and they're going to last longer than 1 year. So it's not going to be expensed in that year. You're going to expense a fraction of that each year. Say you have a truck, you buy a truck for your business, and that truck has a lifetime of 10 years. So you don't want to take the whole value of that truck in the first year because you're putting too much expense on those numbers. So it's not really accurate what that net income would be. So you say, okay, it has a lifetime of 10 years. I am going to expense 1/10 of that each year to show that I'm using it over that lifetime. So you're also in the case of EBITDA, it's the earnings before interest, taxes, and before you take that amortization expense. And so it's just a way to look at the earnings number without some of those other numbers that may sort of skew it in some way.
Talk to us about the importance of financial literacy, and do you think that we're making progress in regards to that?
Oh, that's a great question, Richard. That's one of my goals is I think financial liter, and when I think of financial literacy, I think of, people certainly understanding these concepts, but also it should be taught in school, especially in like high school, before people get out into the world, understanding interest rates on credit cards and how that, understanding, car loans and understanding even how to manage your checkbook and manage your finances in just simple terms. Like you have a job and you make, X amount, and then you're going to have all your expenses, and that's your rent and food and, everything else, clothing, entertainment. And then you have to have some money left over at the bottom. So these management tools that are used in companies, all these financial management tools, really apply to our lives. I mean, in a way, our lives, we are a business. Our lives have a business aspect to it. It's getting and spending, right? It's you get some money in, you spend some money, and hopefully you have some that you save and you put in the bank for when something happens that was a surprise, and you have some money to pay for fixing a flat tire or a leaky roof or whatever it's going to be. You have that money set aside, just like a company would have these type of contingency plans and understand how much sales are coming in and how much expenses they have and managing those things. We need to manage those in our lives. And especially things like credit cards. I think people don't understand a lot of times how oppressive those interest rates are and things. And suddenly you get a credit card and it's like, yippee, I can go buy that flat screen TV and I can go to Las Vegas and I can, go on a cruise and I can buy this really cool car that's going to make me, attractive to whoever I want to be attractive to. And suddenly you rack up, $10,000 worth of credit card debt, and they're charging you 25% a year, which is a giant interest rate. It's like the mob or something, it's like loan sharks. And suddenly on $10,000, 25% a year, that's $2,500 a year that you have to feed this dinosaur just to stay afloat. So it's very easy to get into trouble because there's financial predators out there. And if we don't understand basic financial literacy, then we're prey, and so I think that is the importance. Whether we're making progress with it or not, I think that first of all, we're bombarded by marketing constantly. You go on Facebook, you go on YouTube, you go on, watch television, you look at magazines, you go to a bus stop. Everything is an ad telling us to buy these things. So it's really difficult to have the discipline to not overspend. And that right there is a basic part of financial literacy. And the people that craft advertisements, they're manufacturing desires, and they're very, very good at it. They're very astute at psychologically what makes us tick, so that we will say that's the coolest thing. I've got to have that, and so you go out and buy it, and then maybe you don't use it, or it's overpriced, or you just didn't have enough money. You overreached because you really didn't have enough money to buy it. So then you put it on the credit card because you want it now, and then all of a sudden, your financial stability starts to creep away from a good place. So, yeah, financial literacy is so critical and important. Basic financial literacy, and I think something like that should certainly be taught to everyone, so that we have the tools to sort of at least navigate the world as it is, with predatory finance people like credit card people and predatory marketers that are putting together incredibly attractive ads that seduce us into doing something that we wouldn't otherwise have done, so yeah, I think, it's incredibly important, and it's one of these escalating things that the better everybody can get at financial literacy, the better people are going to get at trying to, take our money out of our wallet, through psychological, manipulation, basically.
Where can people learn more about you and follow you?
Oh, thanks, Richard. Well, I have a whole bunch of, I'm on all the social media channels. I have an email list where I send out financial literacy, these type of things every, weekly. I have a newsletter there. I have a Substack newsletter where I go into more depth on these kind of things. My website, mba-asap.com. It's just a great place to get in touch with me, sign up for my, mailing list, and then, contact me through that and things. Or you can just Google my name, John Cousins, or MBA ASAP, and, in the Google search, a lot of stuff will come up and you can navigate to find me that way. So yeah, I encourage everybody to anybody's interested to please reach out, and I answer all emails and everything.